thanks for coming. This is great to be here in Abu Dhabi, and I want to thank the whole SAL team for another great conference. I've been involved with them for almost a decade, and this is the first time in the Middle East, and I'm sure there'll be many more to come. I'm really pleased to be here with friends of mine. I think we're the only panel that's actually operators, is that correct? That you guys have
Sounds about right.
Mostly managers, yeah. Just to set the stage briefly and kind of frame the conversation, the private market has exploded over the last 5 years, and that's due to a variety of reasons. There are macroeconomic ones, regulatory ones. Most people point to the fact that the maximum amount of public companies we had in this country was in 1996. We're down about 50% off the highs of publicly traded companies. That can be attributed to Sarbanes-Oxley, the Jobs Act of 2012, and then during that same period of time, additional capital coming from the Middle East and Asia into these private businesses. So there's a plethora of reasons as to why it's happening. But we thought it'd be an interesting idea to bring some of these future unicorns out to the Middle East, to this region, because often the investors in this region don't see them until it's too late or they miss the opportunity. So that was kind of the impetus and the genesis for why this panel was put together, and I think it's going to be the beginning of hopefully many other times that you guys come out here. So I think just to get started, when you think of how a company begins, it always starts with a great idea. So there's that eureka moment that someone has in order to start a company. So in a way to kind of flesh out what you guys all do, if you could introduce yourselves, but also go into when that eureka moment happened for you, and where you were and why you thought you needed to start your business. So do you want to start, Ben?
Great. I'll go fast. Hi, my name is Ben Hinsman. I'm the CEO and founder of Splash. Splash is an event marketing software targeted at the enterprise. And my origin story was that I was hosting events. I had thrown a mystery flyaway to Jamaica for JetBlue, and I couldn't believe how much money was on the line for this event. We generated about $1 million at one event. And it was really that, oh my gosh, this is a heck of an opportunity. And I started building a software for myself as an event marketer. And now my software powers all of the events for Airbnb, LinkedIn, Salesforce, Facebook, and Spotify, to name a few. So we are the system of record for all of their events. And it happened because I needed it. I built it for myself.
Hey everyone, my name's Che. I'm one of the co-founders and CEO of a company called Boxed. So I grew up in a place that's otherwise known as the cradle of civilization, New Jersey. And so when
either that or Mesopotamia, I'm not sure.
Yeah.
Right? Yeah.
Well, we're number two. We're the other cradle of civilization. So I just remember being in Costco one day. You know, every other weekend I'd go with my parents to Costco growing up, and I just thought as an adult it kind of sucked, kind of lugging all this stuff home. And this was kind of now almost 6+ years ago when I thought, oh my gosh, with the rise of mobile, why isn't anyone doing this online in terms of just focusing on B2C and B2B in the big bulk quantities? And so that's how we got started. And so we got started literally in a garage in central New Jersey about 6 years ago. And then since then, we've sold over $500 million worth of merchandise. And now it's been a really fun kind of experience, you know, focusing not only, like I said, on B2C, but also B2B as well. Most folks, if you ever fly into the US, for example, you're probably customers of Box without knowing it. So we now service every single public airport in America. All the major airlines use us. And so it's not just B2C these days.
And I can attest to the fact my company has bought thousands of rolls of paper towels.
Yeah.
So my name's Ryan. I run a company called Electric. We do outsourced IT support for companies that don't have their own in-house IT departments. And we're automating most of the manual labor that goes into running an IT department for these companies. Got the idea when I was running my previous startup, and our internet went out, and the IT consultant that we were paying thousands of dollars a month to sort of allegedly look after this stuff was nowhere to be found, and the internet was out for so long that we had to send our sales team home for a day and a half. And so the whole time the internet was down and this IT guy was, you know, AWOL on us, we were losing revenue. And so I kind of looked around at all these different back office functions, whether it was, you know, HR or accounting or insurance. All these different back office utilities were being reinvented with software and, you know, delivered in a much more, you know, efficient and user-friendly way than when they're delivered as a service, but nobody was doing it for IT. And so, that's when the light bulb went off, and I said, this is a huge market. It's a badly needed solution, and I've got to go out and start this. And so that was 3 years ago.
Hi, I'm Dan Turan. I'm the founder of a company called Managed by Q. We help thousands of companies run their office operations. I started working in tech in New York City about a decade ago, and actually Ben and I met in one of the first co-working spaces, and of course now there's a million of them in New York, called Dogpatch Labs back in the day. And I had worked at a handful of startups in New York in various roles. And every company I saw sort of the same set of problems, which was the founders, the founder and CEO, the founding team were spending a disproportionate amount of time trying to manage the office when they really should have been focused on their business. I saw this as my friends were starting companies, and so we really set out at Q to build, the original idea was this operating system for the physical space that could run the office with the reliability of software. And so we set out about 6 years ago to build that. Today we power office operations for about 1,700 companies around the world, including big companies like Uber, Lyft, Amazon, and then thousands of startups.
So Che, just going back to you, when I hear you describe your business, and obviously I'm familiar with it, it sounds like an online combination of Costco and Amazon to put together. Like they've created this baby, and that's what you've started. Is that an accurate description? Are you comfortable with that?
Probably not the most accurate description. Maybe they're kind of bigger versions of Boxed, I would say, instead of vice versa.
Oh, wow, okay. That's good. Yeah.
But for us, I would say there's three main differentiation points. First is the buying experience. So most companies in commerce, when you buy online, you're buying kind of single items. So in the industry, we call that spear phishing. And it works if you're buying, that TV or the chair or most other long tail items. But when you get into consumer packaged goods, that's not how people generally shop. And if you're shipping single item of CPG items across the country, you're going to lose your ass pretty quickly on it. And so it's been a challenge for the industry. So for us, the average order value for, if you just buy dry goods, it's 10 items at about $100 US. And if you buy fresh foods with it, it goes up to about 28 items per order, and over $150 is our average order value. So we can generate actual contribution margin, even though we're shipping this low margin stuff. Second is our focus on B2B. So like I said before, we ship to every airport in America, a lot of huge companies as well, and hopefully to everyone on this panel as well, I think. Mm-hmm. So that's something we specialize in. And how we win those contracts is through the software that we build ourselves. So we build procurement portals where you have the consumer buying experience coupled with an enterprise grade kind of procurement rule software. So for example, for all of your companies, especially if you're big giant companies, you're probably using procurement software that no one likes to use and looks like it was built during the Cold War. And so for us, we have that consumer buying experience, and that's why airlines and other big companies really like it. Third is that we built the front end, middleware, as well as the warehouse management software. And we even engineer and build our own robotics these days to automate our own fulfillment center. So we airlift that entire software stack, and we power big retailers around the world. And so one of our clients is the biggest retailer in Asia. So Aeon Group, $83 billion retailer, is in the middle of airlifting our entire software stack to help run some of their omnichannel.
I visited your fulfillment center out in New Jersey, and I was struck by how automated some of it was. How kind of imperative is that to have an automated fulfillment center or have that aspect of technology?
In developed countries, it's very important because labor is obviously very expensive.
Right.
And so as like getting efficient with how you do things, it's really important. But more and more across the entire world, I think you're going to see a move to automation. And especially if you're going into low margin stuff, like every penny counts. And so if you can automate, you really do have an advantage.
Often when people decide whether they want to invest private, they don't necessarily need to see the exact same kind of company in the public markets, but they want some sort of precedent to give them comfort. Ryan, with Electric, is there a public market comp for what you do? I mean, it's obviously an innovative idea, but who do you compare yourself to? Is there someone out there?
Yeah, we think about this all the time. I think ServiceNow is probably the best public market comp for what we're doing. We see that alignment in a few ways. Obviously one, the vertical focus on IT service management software. We sort of view what we're doing as a ServiceNow sized opportunity, but for the SMB and middle market, whereas ServiceNow is focused on the large enterprise. What they've proven is that a really neglected but large market like IT, if you apply really strict focus on just delivering a great product for that very specific solution to that customer, and build a world-class team around it, and just continue to stay focused on that you can build a phenomenal business. And also similar to them, we don't have any competitors in our space at the moment. So my investors like to remind me that it's basically ours to lose at this point.
How big is ServiceNow?
I think it was a $9 billion market cap company when they IPO'd a few years ago, and they trade at $55 billion now.
Wow. And you're already a subscription business, right?
Yep.
Yeah. So how do you scale it further from here? What do you need to do?
Well, I mean, I think like all of us on this panel, we like to think of ourselves as responsible stewards of capital, right? So just sort of buying your way into a market. Some companies can do that. That's definitely not the path that we've chosen to take. We've had a very, very strict focus on unit economics since day one. I mean, I think, Chain, your business, talking about margins, I mean, if you didn't do that, you wouldn't be able to still be in business. So, the scalability really just comes down to being smart about the nuts and bolts of the numbers, and making sure that if you're spending $1 to get $1.50, that you can maintain that over time.
Right. So Ben, you come up with this idea, and then you execute it. But I look, intuitively, I would have thought that some of your clients might have wanted to build it yourself. But your clients are Amazon, Salesforce. Rather than trying to get into the event game themselves, they were just hiring you. What does that tell you?
Yeah, no, I think, I mean, it's pretty interesting to be on stage with Dan and with Ryan. My business and theirs are similar in that we are vertical specific solutions, and it kind of speaks in my mind what you're pointing out to where we're at in the software cycle. Salesforce IPO'd about 16 years ago, and they're about a $16 billion business. And right now, their ecosystem, so there's about 6,000 businesses on top of Salesforce's ecosystem, us being one of them, and they're really, it's allowing us to both scale into their ecosystem, use their ecosystem for growth, but also really focus on being really good at one user type. And so while sure, Salesforce or Facebook, one of our customers, or LinkedIn, one of our customers, they could build this, but we're just going so deep and using their pipes to do it that they've kind of in a way forfeited the market, identified us as best in class, and hire us, but also kind of go to market with us. And so I do think that's what you're going to start to see moving forward, businesses that just hyper-target on a user type, automate or give the best in class tools to that user, and really then scale and grow and become kind of the industry standard for that vertical.
So we're at a conference. Did the Saul conference use your
Yeah, I mean,
service?
the app
Okay.
was terrible.
Right.
I mean, look, I also love that these are our customers because it speaks to, I mean, we are seeing an increase in face-to-face marketing. Digital is saturated. It's really hard to acquire customers. It's hard to drive deals in digital. I've had really powerful conversations at this conference.
Gotten a lot of cards, yeah.
Yeah, a lot of cards, and these pieces of paper you throw away.
Right.
It's it really. While I do think that in a lot of ways you've seen a lot of software that has tried to automate and make this experience more fluid, I just don't even think we've even seen the beginning of the in-person or face-to-face solution era. I think in the next couple of years, you're going to start to see data and cheaper screens and automation just completely take over this type of selling experience.
Yeah, it is crazy how it seems so antiquated that we hand people these cards.
It's insane.
Use them. Yeah, but that's great that you're thinking ahead about
That's what we're working on.
Yep. So Dan, you were a successful CEO. I think you raised about $100 million for this business, and then you sold it this past April to a small company called WeWork, I think. For about $220 million. So tell us a little bit about the thought process there and that sale. And then as a result of that sale, you didn't just go away. You actually went and had a front row seat. You worked at WeWork reporting to the CEO, correct?
Correct.
Yeah.
And Dan, this is all off the record, so just.
Except it's not at
I
all.
don't think that's true, Ben.
You're in a safe space.
Yeah, so I've known Adam and Miguel, the founders of WeWork, for a number of years now, and it was, I would say, a long courtship that unfortunately did not make for a long marriage. So we've been having a conversation over a number of years, and in April made the decision to join them. The reported price was $220 million. We felt it was a really good deal for our team and for our investors, but I would say more importantly, at the time, we were highly convicted that their scale and platform and access to capital was going to give us an opportunity to realize sort of the next chapter for our business. And as Omeed alluded to, I joined their leadership team running corporate development, so I ran M&A, investments and partnerships, as well as the platform of acquired companies at WeWork, and then about a month and a half ago made the decision to move on and focus full time on making an effort to buy my company back from WeWork. Obviously things didn't pan out quite the way we had intended there, but are still super excited about our business, and fortunately have found a lot of support from the investment community to make Managed by Q an independent company again.
All right, so just to be clear, you're now in a process of buying back a company you sold less than 8 months later?
Yeah, correct.
Okay. And I'm assuming you're getting a pretty healthy discount?
You can infer from WeWork's current situation that, they're...
Okay, moving on. So thanks for that. But we bring up WeWork, but it has looked like the whole WeWork situation has created a bit of a correction in the private market. I mean, we'd be remiss if we didn't mention that. But in a way, at least in my own opinion, I'd love to hear yours, it's healthy. You did need a bit of a correction in a market that had gone frothy. And if anything else, what we hear most from investors is we don't want companies that are just going to buy growth. We want to hear about a path to profitability. For all of you, how much is that factoring into your day-to-day?
Yeah, I mean, I think as 6 months ago, I would have told you that I was never going to have to raise capital again, and 6 months later, in the middle of another capital raise. And so I have a pretty good sense of what markets are looking for right now. And I think there is, to your point, Omeed, there's been a very healthy shift to fundamentals, which tends to kind of happen on a cycle. And I think it's preventing a much larger shakeout from occurring. This is sort of like a bit of a shock to the system. But you're seeing founders respond and react and adjust their plans because the markets are telling them we want to see profitability, we want to see strong fundamentals. And we've made significant changes to our plan and are super excited about being profitable in the near future as we reemerge as an independent company. I would also say for pretty much all of our businesses on stage here, this kind of tailwind of focusing on efficiency, profitability is also giving a lot of life to companies that help other companies do that. So Ryan makes your IT more efficient, Ben makes your events managers more efficient, Che helps you reduce your spend on essentials, we help you run your workplace more efficiently. So we're actually seeing a lot of demand from the market for products and services that are going to help businesses scale more efficiently.
Yeah, I can attest to that. We only have, on a company, every if you counted every single person we run payroll for, it's probably like 500-600 people these days, and we have one full-time IT person because we use electric, so it's about as efficient as you can get because you can't take that to zero. So yeah, I can test that.
I mean, just to throw it out there, while certainly profitability matters, and I think certainly every time we fundraise nowadays, we're looking to find that profitability. The types of acquisitions that we're seeing based off of growth rate are pretty astounding. I mean, at least in the B2B space, Salesforce has gone on a shopping spree and most recently acquired a business for $17 billion, Tableau, and they acquired MuleSoft for $7 billion. So we're seeing just really crazy acquisitions, and a lot of that is tied to growth rate. So while I'm totally with you, we're in this fun part of the cycle. We do need to focus on efficiency. Growth still, I think, remains.
Right, you don't want to be so focused on that you lose the growth, is basically what we're saying. You've got to find that happy medium. Maybe we went too far, but you don't want the pendulum to swing all the way to the other side.
Exactly right. And it's all about unit economics. I mean, as Ryan talked about earlier, you can do this, especially with the SaaS model, the revenue stacking.
Yeah. Ryan, do you want to, or Che?
Well, yeah. I mean, look, if you're right side up on your unit economics, and you're looking at a company that's roughly at kind of our stage, as an investor, you can always underwrite to a 10x or more return because there's a clear machine that's working. You put $1 in on one side and 2 is going to come out the other. And so I think where the market's headed right now is any astute investor is looking at a company and basically saying, does the math add up? And so if you've got a really repeatable and profitable go-to-market motion, even if the company itself is not profitable, if the growth levers are profitable, then that typically presents a pretty clear path to upside.
I mean, the statistics are demonstrating, as I started from the outset, that companies are staying private a lot longer. Maybe in the old days, end quote, you would get your venture money and then within a few years there'd be an exit. That's simply not happening anymore, at least as it relates to IPOs and public markets, public exits. Does that change the way you think about building a business now because maybe that option is not as imminent as it once was?
I think it certainly does. Now that we're 5-6 years in, as we think about that being a potential kind of option in the future for us, you definitely want to tune not only kind of your growth rate so that you're not like burning out, so that by the time you do make it public that like you're having a growth rate that's trailing off, and also that you want to build a business so that you actually have predictable growth, predictable margins, because in recent IPOs, anyone who like kind of really kind of misses any time in their first year, like you just see that the stock never really recovers. So really being ready for that moment, that you can like on a dime and within a few basis points know what you're going to do next quarter, is something that when we were 2 years old, we certainly could not do, and so that's something we're driving for.
But for both founders and investors, the asset class overall has matured quite a bit, even in the last 5 years. So, for early investors in companies like ours, the opportunities to actually achieve liquidity, in the absence of an IPO or some other type of exit event, those things are relatively commonplace now, and they weren't 5-7 years ago. And so I think for founders, it creates a lot more optionality, because you can take a much longer view to how you run the business. At the same time, you don't have to hamstring people on your cap table. We've got some early investors in our company that may choose to take a little bit of their position off the table in the next round, not because they don't believe in the business, but just because for their mix and their allocations, that's what they want to do. 5-10 years ago, you couldn't do that. It was sort of, you either had to go for the quick flip, or you were in it for the long haul. Now it's a much more friendly environment for all types of investors.
That's a really important point, and I should have mentioned it earlier on. It's one of the reasons we have a business at Farvahar is not only to what you're describing, but the liquidity that you now have a robust secondary market that's actually developing as well. That's a game changer to create this parallel market in the private space, where even as, forget about insiders and employees, which are imperative, but now you can have speculators come in and buy and sell before an exit as well. That also creates a situation where these companies are going to be able to stay private a lot longer. It's just another infusion of capital.
Yeah, I think you're also seeing for employees, there's liquidity options that didn't used to exist. So in the form of those speculators, but also tender offers are becoming sort of commonplace for later stage private companies. I think all of these things start to create a healthier late stage private ecosystem.
Right, because otherwise that was a huge issue with attrition, that if you can't get these people the exit, then they can't afford to make the first house purchase or what have you, and now there are options for them. So I think that's another really, really important and positive development. And then, not to mention with rates where they are, you're still going to have people searching for yield, and they're going to come into this area too. So it's all interconnected, and that's why it's funny when I talk to people, they say, well, this just happened. What happened? No, it's been going for 15 or 20 years. You're just seeing the maturation of it now. I do want to pose kind of maybe a policy question, and it might not be the right audience with you guys, but when you think about majors buying these niche businesses at huge premiums and eating them up, I mean, it's a good thing for the owner and probably the company. But do you worry about the majors now, the incumbents, creating these monopolies that actually stifle innovation in a way?
Certainly.
Not to go too meta, but like...
No, it's a very challenging time to build a startup. And in a lot of ways, I mean, we started off in 2012. I think it'd be a very different thing to try to start a business today than when we were starting.
Well, it's a lot easier. I think
You think today it's easier?
It's way easier today.
Say more.
I mean, like all of the building blocks, even like web services weren't like fully fleshed out when we started our businesses. And so I think like there's just so many building blocks to build a company today that didn't used to exist. Like even the things that we've built help other people build their companies faster and more effectively. I think in terms of like the M&A activity, and so the fact that the specter always looms that you might get a very attractive offer from a very big tech company, I think actually is causing more people to start companies. So I think it's, in a way, it's good for the ecosystem. And I think as a founder and as an executive, it is your choice to take that offer or decide that you want to go it alone. And I think, Che is probably a great example. People, I am sure, have told him for the better part of the last decade that he's an idiot for trying to compete with Amazon. But if if he let that drive his thinking, he would have never gotten out of bed. He's built an incredible business.
Thank you, Dan. I think when it comes to at least part of the kind of industry that our company touches, consumer packaged goods, I don't think like you're going to see a massive CPG company come anytime soon, solely because of that dynamic. Like
Right.
anytime you have any modicum of success with packaged goods, whether it's George Clooney with tequila, whether it's Harry's with razors, like
Yeah.
someone comes in and snaps it up. And so I'd be very surprised over the next 10 years if you were a vertically integrated brand selling a certain product in the CPG market, that you'd actually kind of grow to a 10 billion plus market cap.
And I think you're totally accurate. That raises less policy questions, though, than Facebook buying up unrelated things, maybe like Instagram or
I think
WhatsApp and things like that.
That
right?
poses broader questions sort of for the average person, but I think as a founder, it actually makes it more attractive to start a company because it just
Sure.
gives you more options.
Yeah, and ultimately, if you look at Facebook and you look at Google, Google has somehow figured out how to build technology that has harnessed all of the world's web searches, and still all they've managed to do is sell advertising with the data, right? And kind of Facebook, same way. So once you step outside of just this digital ad ecosystem, the barriers to entry to starting a company and acquiring a customer are the lowest they've ever been. So I think what we'll start to see in B2B software and in CPG is actually increasing fragmentation, and probably less likely to see kind of a monopolistic structure in a lot of these businesses.
Right. Just given everything we've talked about, how have your thoughts about an ideal cap table evolved? I mean, you hear some of these, when we talk about the negative connotations associated with this market, it's a company that isn't really a tech company, but it's just a marketing branding company that doesn't do anything different and has a bunch of influencers and celebrities on their cap table. I mean, how do you do everything in your power to not be that?
We need strong governance, right? So
Right.
like what any investor in this room or outside of the room doesn't want is, some egotistical founder who's going to run their company into the ground, right? And so I think, like even in our case, we have some outstanding investors. One of the things that I did was, worked with my investors in the last round to actually institute, more mature governance, around, board structure and terms for the round, because ultimately what that, signals to investors in later rounds is that, this is a grown-up business that is taking a long view on what they want to do. I think, I could probably speak for all of us here, like, I don't think we would want to be going to market with like, super voting shares and, total control over our companies.
Yeah, just how our cap table has evolved has been pretty interesting as well. Like, we had a board member come into one of our recent board meetings and said, because we have early stage folks still on the board, we have mid-stage financial investors, we have the largest retailer in Asia on our board, so American Express is on our board. So one of our board members walked in, it's like, dude, like, whenever I walk into the boardroom at a Box board meeting, it feels like I walked into the Star Wars bar. It's like every species in the universe is here. And so, but it's made for really good debate. And so I think if you just have kind of like early stage financial investors, then every day in your inbox are going to be kind of medium articles that they're going to forward to you on how to run your business. And then if it's just strategics, they also don't know what it's like to run an early stage business. So kind of having that diversity of thought, I think, is pretty important.
Well,
Dan,
again,
yours is the same way. I mean, you had strategic.
Oh, because you had Staples on your board.
Yeah,
you had an architect.
I'm beginning to
point.
feel like I'm a bad luck charm because we did a deal with Staples, and within 2 months they were taken private, and the entire executive team was fired. So the executive team that we did the deal with Staples with was very different than the one that we remained going forward. But yeah, we found them to be a good partner. They participated in our Series C. They had a board seat, and we had a bit of a distribution partnership with them, but with the regime change, and they had a lot of layoffs on their end. It didn't end up being quite what we had intended, but I would say, when choosing a corporate venture capital partner, I think like long-term alignment around the customer is really important, and we felt like that was the case with them.
Yeah, I mean, there's no doubt that, again, I think this is kind of a manifestation of it, that these lines are all being blurred tremendously, and we're seeing that play out on cap tables.
But I guess I would call out, just because we're at this conference, the ability to hit a new market can be totally unlocked by a new investor. We just came into EMEA. We brought in a strategic in order to kind of go attack that market, and it was fundamentally a game changer for us.
Right.
So certainly a conference like this, coming into MENA, that's value that many investors could offer.
No interview with CEOs is complete without asking about culture. I mean, you just have to ask it. It's like the number one cliche. So let me just put a twist on that. How overrated is culture, and is it just BS?
Define culture?
Exactly.
Yeah.
Well, I mean, really what you're talking about is leadership. You know, the best companies on the planet, you know, tend to have world-class leadership teams. You're not really going to accomplish anything great without phenomenal people. So my point of view generally on culture is that it starts by building a phenomenal, cohesive leadership team, challenging yourselves to solve hard problems together. The culture, at least in our business, winds up being the byproduct of these things that you do with these incredible people. So from that perspective, I don't think it's overrated. I think that the leadership and the culture is the business. Often, though, in Silicon Valley, you know, culture is like beanbag chairs and ping pong tables and free lunch. That's probably the wrong type of culture.
Yeah, I think I would say, like, I've seen companies be built kind of two types of ways. One is you have this great idea, insane product market fit out of the gates, and you are literally building a machine to execute that one thing. And what you get there can be a very frail organization, because the thing was built to literally do one thing and one thing only. Versus building what I think is a better type of culture is you build an organization that ingests and solves problems together, and what you get is resiliency. And so when the business changes or things aren't going so well, you have a team that hangs together and figures out how to solve problems together. I think there's been plenty of shakeouts recently, lots of companies that don't need to be named at a big scale, where not having a really strong culture has created a lot of issues through challenging times. And I would say one of the things that's been great in the last 6 months at my company, at Managed by Q, is the team's hung together. I mean, they've worked together for a long time. They want to stick together. And as we're looking at this spin-out option, you know, I have recruiters telling me that they can hire from any of the other subsidiaries, but when they call my engineers, they are going to wait and see what happens, because they don't want to leave. And I think that's something that you only get from investing in culture over a long period of time.
It's purely coincidental. We didn't think about it when we put you guys together, but all of you are based in New York, not San Francisco. What does that say?
Says there's life in tech outside of San Francisco, you know, and that the market is maturing. You know, we're now kind of, most of us on the stage, if not all of us, are kind of multi-time founders now, having collectively raised probably like, you know, maybe even getting close to $1 billion these days. And that you can build companies anywhere in the world, whether it be at New York or Abu Dhabi.
I think, like, one of the things that's unique about all of our businesses is I actually believe that none of us would have been funded as you know, first-time early entrepreneurs in San Francisco with the businesses we were pitching then. So we all built businesses that were solving a problem for a customer, but didn't fit the mold of sort of the traditional Silicon Valley SaaS pitch. And we've, you know, iterated and figured it out and built great businesses. But I actually think being in New York was an advantage for us.
Yeah.
Well, in San Francisco, everyone's trying so hard to be different that they all wind up being the same. You know, and the point that I made earlier was, like, in New York, the money's the same color, right? If you're going after a huge market with a compelling business model, just because it doesn't fit the perfect, you know, B2B software mold that, you know, a Bay Area investor is looking for, well, in New York, it kind of doesn't matter, right? If it's a great team, a great market, people want in.
Yeah, it's changed over time too, because when we first started, we weren't based in New York, we were based in Jersey, as I said, and getting a Silicon Valley investor to come visit you in New Jersey was impossible, dude. They're like, I go for one reason, and it's Newark Airport, and I hate it. And so I'm not going to add a second that I'm going to hate as well, so it was just hard to, you know.
Yeah. And let's just quickly call it out. Work is changing. About half my company doesn't work in New York, but we're headquartered there because that's where all of our potential clients are, or many of which are. So we're just seeing a totally different way of hiring, and I think that's going to make it so that it kind of doesn't matter where you are.
Before I let you guys go, give me a kind of contrarian view that you have on that makes your businesses would still work, though, despite it.
Yeah, I mean, the bet that we made, 6 years ago, 7 years ago when we started working on Q, is that the workplace still matters. So to Ben's point, like, you can work anywhere. Like, we fundamentally believe that the best work and the highest leverage people are always going to work in a workplace together and solve problems together. So one of the things we were told is that, like, with this rise of remote culture, we were building a business that wouldn't matter. And our point of view was that's just not true. Unfortunately, you know, we're seeing companies spend more on their offices per employee every single year, and it seems to be panning out. And I think with WeWork, there's still an incredible business in there, and I think they really, hit the nail on the head in terms of this zeitgeist of really making the workplace experience something that attracts and retains talent and makes people excited to show up to work rather than go work in a cube.
In our case, sometimes the way to build a world-class software company is actually to start with a lot of people and services first. Use that to actually create a data asset that you can use to map out the software that you want to build and then automate it away over time. It's a little bit backwards, but it's worked quite well for us.
For me, it would be online commerce is so large that if you focus on specific regions in the world or specific kind of use cases within an industry, you can still build a gigantic company doing so.
Sure, and ours is, we operate in a relatively crowded space, but our customers don't see it that way.
You were told that last night.
I was told that last night by Tim Draper. He said, it's a pretty crowded space you're in.
Yeah.
I said, I'm going to have to win it, I guess.
right after.
No customer ever describes a space as crowded.
That's right. I think we are fundamentally at a shift in technology that allows totally new solutions to come into play, and we're showing that, so it's...
Well, guys, this was awesome. Thank you very much for making the trip out here, and please join me in thanking them for their time. Thank you.